Let's now speak about recognition and measurement rules in IFRS standards. The conceptual framework for financial reporting assumes that there should be recognition, measurement, and disclosure concepts. There are some assumptions, principles, and constraints associated with this framework. As for the assumptions, we need to understand that financial reporting should be represented by a single economic entity, separate economic entity. The economic entity should be of a going concern, which means should be able to operate in a foreseeable future. Monetary unit, which means that all financial statements should be represented in terms of money. Periodicity, which works for consistency of presentation, and financial reports will be represented every half of the year or every year or even every quarter, depending on the aim. And accrual concept, which will be considered later on in this course. As for the principles, we need to be aware here about the measurement principles, revenue recognition, expense recognition, and disclosure issues, which overall covers the volume of the information which is represented in the financial statements. As for the constraints, we should always be aware of the cost, whether what we are doing in terms of financial reporting is worth of its cost. Let's consider the measurement principle, and this will be represented as a process by which monetary values of the various financial statements elements are determined. So we will measure each item of financial statement, each element of financial statement, and we will determine its value. It is at these monetary values that basic elements are recognized and carried out in the statement of financial position and statement of comprehensive income, or in other words, in the balance sheet and income statement. We will be able to use two basic measurement principles: historical cost and fair value. The historical cost generally is thought to be a quite faithful representation of the amount which was paid for a given item, though it is always based on some past transactions, and this will be closely referred to the bookkeeping. The fair value measurement will be defined as the price that would be received to sell an asset or paid to transfer a liability. But this will refer to the market prices, because such operations are done between the market participants at the measurement date. The revenue recognition principle requires that companies should recognize the revenue in that accounting period in which the performance obligation is met. And when company agrees to perform some service or to sell some goods to customers, it will always result in a performance obligation. Now, expense recognition principle assumes that there will be outflows or using up of assets or incurring of liabilities during a period, and this will be represented as a result of delivering or producing goods or providing services. And finally, full disclosure principle, which means that companies should provide information that is of sufficient importance and that can influence investor decisions in that needed volume. Under the measurement basis, we will consider once again historical cost and current value measurement base, because we will use this measurement to different degree. and in varying combinations in our financial statements. Let's consider the historical cost and current value in details. As for the historical cost, you will notice that it's quite easy to calculate and comprehend because such cost is a result, forms as a result of past transactions, meaning that information can be easily subtracted out of our transactions, out of the bookkeeping system. It is relatively objective and will be free from bias because something which happened you cannot change, and it lacks subjectivity. It also facilitates easy forecasting and will be quite easy to verify because you can always make an inquiry to the third party. Now, as for the current value or market value, well, we must say that this will be a fair value because it is on the market level, not based on the historical cost, which might have happened years ago. Now, this will be value in use, and it will represent current cost, not the historical one. Now, let's think about the disadvantages of using historical cost base. The main disadvantage, as you might already understood, is that it does not reflect the current value of assets or of the liabilities. Such information would be obviously considered to be more useful by the investors or by the users of financial statements. Now, assume that company have bought a building 10 years ago and it costed $100,000. Now, what will be the cost in 5 years? The historical cost will remain the same, but what about the market cost? Of course, sometimes it's more reliable and more understandable to use current measurement basis, which include fair value, or the price that would be received to sell an asset right now in the market. It reflects market participants' current expectations about the amount, and it reflects entity-specific current expectation about this particular amount. The current cost reflects the current amount that would be paid to acquire an equivalent asset, meaning the same, with the same characteristics or similar characteristics, will be received to take on an equivalent liability, meaning on the same terms, on the comparable terms. And the key advantage of current cost approach is that it will provide our users with more relevant information. And this information will basically reflect current state and performance of our company. Now, what are the drawbacks of such approach? Current cost will be typically considered to be more subjective and therefore less reliable than the historical cost approach. Of course, because it's all based on the measurement. The applying of such approach might prove a complex task and will be definitely less familiar to users of financial information. Monetary items will be still carried at their historical cost, and it might not be relevant under current market conditions. And also, it may sometimes be quite difficult to obtain appropriate current cost values for all non-current assets, especially if no market for such assets exists. Consider if company produces some new product. How to measure the fair value? We will now look at accounting information system.